Any questions?
Hi, my name is Eva Luthi, and I'm a transfer pricing manager at Schroders. I have a question on a point Michael just mentioned on fairness, but the question is maybe more towards Pascal. You said like one of the principles is fairness, and you already admitted that it's really hard to say, so what does fairness mean? And with that whole digital initiative, it's very interesting is we actually get into this question of like, what is it you are moving towards? Until now, we were following the arm's length standard, where it was, maybe it's not fair, but at least we're saying we are following what the market does. So between related parties are doing the same, what happens in a market, which might not be fair, but it's a standard we follow. So now as we're moving away from the arm's length standard, we're moving towards a more moral goalpost, which will be much harder to define. And so my question is, Pascal, what is your thinking about this trade-off between fairness and arm's length? The arm's length is easy to explain. This will also be much harder to explain, as what Janine said earlier, to the public. So what do we communicate? Like this is now what we feel is fair taxation.
Thanks. We'll collect a few questions. So there's a question by Mihir Desai from Harvard.
So I just want to return to Mike Williams's metaphor of an exam question. And I want to make sure I understand what the exam question is, because I'm still not sure what the exam question is. So there's kind of one very deep political question, which is, in an age of rising populism, how do you address the seemingly egregious activities of US multinational firms with a digital character and people's distaste for what they do? That's one version of the exam question. The second version of the exam question is a deep legal and economic question, which is the entire international tax system is broken and we need a new system. I'm not sure which it is. Is it a deep political question or is it a deep legal and economic question that we're addressing with the digital initiative?
Okay. Any further questions? Okay, I'll give you some more time to think. I thought you'd all have a huge number of questions, but let's start with these two questions. So, Pascal?
That's a good question, which would take some reflection. Is the arm's length principle easy to explain to the public, as I think you said? I'm not sure of. It's pretty simple, though. I mean, yes, you ask companies that you take as separate legal entities, de jouer à la marchande, as we say in French. You know, when you're a kid, you play, I buy this to you, and then you give fake money. And that's what we oblige companies to do with the arm's length principle. And in a world which was simpler than it is today, with fewer multinational companies, less integrated, probably it was fine. When you have all the residuals / excess / above normal return concentrated on IP, where you have no benchmark, meaning no routine. If we take the definition of routine as benchmarkable, it's really hard to explain that the arm's length principle works well and is easy to allocate stuff. So that's the first element of reflection. The second, and that may be the link between BEPS 1 and BEPS 2. BEPS 1, including with the word value creation or the expression value creation, was about saying what we are sure of is that there is no value created in a tax haven where nothing is happening. So BEPS 1 was about closing down the loopholes where you had trillions of dollars of profit in zero tax jurisdiction where nothing was happening. And what was touched upon in BEPS 1 in the conclusion of Action 1 report, which had been kept away from the action plan, and this is explicit in the document adopted in July 13 by finance ministers and then leaders of the G20, which precisely was the allocation of taxing rights. So we started a project saying we don't touch on the allocation of taxing rights. We just close down loopholes, and we use the term value creation almost negatively to say we know that there is no value created where you just have a trustee or a lawyer and his or her dog, and that's for sure. BEPS 2 is about drawing on the conclusions which were at the end of Action 1 report, saying, well, the tax challenges of the digitalization of the economy, whether it's a slogan or not, but are about allocation of taxing right. And there are probably many ways of looking at it. One very practical way, which is my way, as in charge of facilitating the discussion and facilitating the agreement, you need to make sure that countries are not too unhappy with the system. Because if they are too unhappy with the system, then they walk away from the system. And we take it for granted that a system or an agreement or common rules is better than the absence of common rules, because then you have unilateral measures, you have all these tax sovereignties, which can do whatever they want, including terminating their treaties. But then you have a real risk of double, multiple taxation that we take for granted, but I think it's supported economically, is no good. What's happening, if I may be a bit audacious here, is that the digitalization of the economy has turned traditionally exporting capital exporting countries into developing countries, digital developing countries, right? You have people who do business on your territory, they have brains, they have capital. The difference with what happened before is that they can even do that without being physically present. And they mine your data, they use these, they are able to use the deficiencies of the system to monetize their profit in third countries, which are generally low tax countries, no longer zero tax economies, I think largely because of BEPS and the US tax reform, which is a way of implementing BEPS. And these countries say, well, we have a problem, as developing countries vis-a-vis these capital exporting countries said in the past. And that reopens the debate at the time where I think the US, with its tax reform, moving territorial with, a floor to territoriality, which is the guilty, accepts that it's not only a capital exporting country, but also a trade deficit country, and therefore having some form of destination, to use that word, of some form of market taxation makes sense. So all these elements together, I think, put such a stress on the system that there is a recognition that there is a need to move away from the ALP as it is today, not to say to trash it. I would think that most of the countries, if not all the governments, would recognize that for what we call routine transactions, but easy stuff, it works. Probably, I don't know what's the rate, but 80% of the transactions, but for 20% of the value. And where the big value is linked to intangible because of the integration of the value chain, doesn't work well. And we've been struggling with that. Special measures, hard to value intangible. We didn't get there because countries were not ready to move there. And the combination of the US tax reform plus this digital thing, which makes European countries in particular think slightly otherwise than in the past, may be the opportunity to move. And to come up with a system which will be easier to explain, because frankly speaking, yes, to students in law or maybe economists, you can explain the arm's length principle. We just ask companies to mock the market, to play as if it was market price. And when you come to intangible, which are not benchmarkable and which will be located in low tax jurisdiction, you can see the limit of the system. And that's what we're struggling in particular with highly profitable companies, which are the digital companies. And as Mike said, or somebody else, digital companies are not, I think, only those using user contribution and all that, but also manufacturing some devices. And so that's what, the French call the GAFA, which is Google, Apple, Facebook, Amazon, and you can see very different business models there.
Thank you very much. Mike, would you like to address this question?
Can I, on the arm's length principle, just say, I very much agree with Pascal. I mean, some of it works fine, and I would imagine that we will keep that bit. But I think it's very difficult to defend the way it allows the artificial segregation of assets, activities, and risks in a multinational group. I think once you've seen that can be done, why is that a fair or a good thing? To an extent, you've obviously got to compare, would anything else be better? But on the other hand, it does enable very odd results. And, it also has created this vast industry of people producing these sort of immensely thick reports that then get sort of agonised over and sort of debated endlessly. That I think it's not accessible, I think, either as well as fair. I mean, on Mia's question, I mean, I think it's not enormously surprising that when people noticed that some businesses seem not to be paying much tax anywhere, that they got bothered about that, maybe to an extent that has then been whipped up into a populist concern. But you could argue that people were not interested enough in who was paying tax and where. I think then they're plainly concerned about this because of that perception. I think it links to fairness. Why were they concerned? I think the international tax rules had not been kept up to date, and I think you could say that BEPS came too late. It should have been done sooner, and you can explore the history of that and see why. Equally, I think that this digital question is very clearly the unfinished business from BEPS. So, I mean, I think if people believe that the system is fairer, then I think they will be more satisfied with it. Are they going to get involved to any great extent in the detail of how the system works? I wouldn't have thought so, but then that's true in other areas and other activities. I think equally, Johnny is right. Business is going to have to keep explaining, and people are all going to have to explain. It's all hard to explain. There's difference between profits and revenue, but I think that's easier to do against the background of a system that is reasonably fit for purpose as compared to one that have been rather neglected and there have been developments that it hadn't responded to. I think that's where the difficulty lies. Whether things having got to where they are, you can just quickly move back, I doubt. But on the other hand, I think if you did have a system that was perceived to be more fair than quite a lot of the concerns probably would die away over time.
Okay, thank you, Mike. So we have 3 more questions. So would you tell us your name and where you're from, please?
Hi, everyone. And my name is Francis, and I'm from the University of Hong Kong. And my question is for all of you, as I forgot which module it was from. So my first question is, among 5 criteria for evaluation, you mentioned about the fairness, and I wonder that what kind of fairness are you referring to? Because are you talking about the system's fairness or legislation's fairness, or in terms of consequence, or in terms of the performance, or the market competition, or in terms of other things? I wonder, can you kind of evaluate? Can you kind of explain it more in detail? And my second question is about the 4th criterion for evaluation, which is ease of administration. So I wonder, like, for when you're talking about ease of administration, so won't it lead to a lack of the supervision over the market objectives? For example, maybe firms will choose the methods to maximize its own interest to the maximum, and maybe it will in turns harm the market order. For example, if you ease the administration, maybe too much freedom and liberty, and maybe it will lead to the liberalism. So won't it kind of in turn harm the overall market older. And my last question is about the fifth criterion for evaluation. It's incentive compatibility. So in terms of incentives, what kind of incentives do you think it's healthy to the whole market? So is it for example, in terms of I think the foundation of the capitalism to maximize one's own interest, because to my perception, like the capitalism is founded based on one is individualism, the other one is commercialization. So do you think that to maximize the incentive, to make the incentives beneficial to the whole market?
Okay, we're running out of time, so you put forward your three questions.
One last sentence. The incentives are about to maximize one's own interest or to benefit the whole development of the market. The companies should kind of realize more about the social responsibility at CSR, corporate social responsibility, which may in turn affect its.
That's a very long sentence. So thank you very much.
Sorry, I'm really sorry. Thank you very much, and thank you for your preparation. You must have invested lots of time. Thank you.
Thank you very much.
James Hines, University of Michigan. My question's for Pascal. Are you concerned at all that if we willingly move away from the arm's length principle and say that's what we're doing, that there may not be much limit to how far the international system is apt to go? And this kind of picks up on Mike Williams' point, I think, from earlier, that countries will start to do grabs of revenue that would be distortionary and harmful in ways that nobody really intends now. I will give you an example. If we think of value creation by internet users as, exchange of their personal information and contributions, and that is value creation that appropriately leads to some taxation of where users are located, shouldn't we think the same thing about the local bar or pub? So say you go to a bar and they sell you a drink for 12. It costs them 10 to produce the drink. And so we would normally say, oh, the profit is 2, and therefore there's taxable income of 2, the difference between revenues and costs. But the reason that people go to bars and buy drinks there is so that they can talk to each other. And when they're talking to each other, that's why they go. That's why they're willing to spend 12 to get a drink. Shouldn't it be the case then, in this reasoning, that the people who are at the bar are creating value for each other, and that should be subject to tax? It should be subject to income tax of the people who are there, who are enjoying each other's services. It should be subject to social insurance taxes, because after all, this is labor services. And it should be subject to sales tax for conversation services. It seems that is the logical implication of the approach that is outlined in Pillar 1. And wouldn't that then create the possibility that governments around the world would each, not necessarily apply it in the case of bars, but I think you get the idea, completely deviate from what we have normally accepted as income tax principles? And that has worked, admittedly with a lot of problems, but the fundamental system has generated revenue for governments in a reasonably efficient way for a century now. Should we be concerned about that?
So there's one final question by Angela Sidel.
Thank you. I would like to return back to Mike's final point about Pillar 2 proposal and the incentive compatibility aspect of it. I would be very interested to hear the views of Pascal and Mike Williams in response to that comment, because academically it sounds very plausible. What is the real politics answer to that incentive incompatibility of Pillar 1?
Okay, so I think we can, the 4 panelists can have a go at whichever question catches their fancy. So we'll start, and they can also make some final remarks. So we'll start with Mike.
Okay, thanks. Well, I would address your first 3 or 4 questions, but time is getting on and people want a coffee, unfortunately, and it would take quite a long time to go through them all in detail. But briefly, I think fairness is a particularly difficult one, and you raised fairness as well. That I think the kind of issue of fairness is, you could think of it as a kind of much deeper level, in the sense of, if the government in country A is collecting revenue, do we think that it's people in country A who live in country A that are actually providing that revenue ultimately, or people in some other country? I think one of the things that many people think is a good thing about corporation tax is that we can tax foreigners. So we have, an American multinational operating in the UK, we can tax it, and that ultimately is borne by Americans. So I think, there are kind of rather deep questions about what we think about fairness. And I think actually the way that we design the tax system has a big impact on actually who bears that tax. But there's clearly a lot more that we could say about that, but I'm not going to. I think Jim's example is very good. I'm not sure, nobody else in the bar is actually receiving any income. It's the owner of the bar which is getting all the income. So isn't it the owner of the bar that should be taxed? But anyway, we could talk about that over coffee as well.
Well, I mean, interesting example with the bar. I take it's not a hostess bar, but it sounded like. So there may be other income which should be taxable anyway. I mean, you ask a very good question. If you start departing from an agreed principle, where do you stop, and what does replace that? Good question. And you say, well, why wouldn't countries take unilateral measures? Are you not describing, or are you not realizing that you're describing what's happening? Countries being so unhappy with the Amsterdam principle as is, that they're taking unilateral measures. And not only developing countries where you could say, well, they don't have the means to really cope with the system and so on. United Kingdom, France, attempted by the European Union. I mean, it's now moving to the core membership of the OECD. So you can ignore and say, we have a principle, we keep it, and hold the fort, where actually everybody is already in the fort, and say, no, we keep it unchanged. So I would see more risk of not opening the debate and not trying to fix what I think growingly is agreed as needing a fix. So you're right. When fixing it, you need principles. I think that's what Mike said earlier. You need some form of principle. Otherwise, and I tried to say it also, you do BEPS 2 and then you need to do BEPS 3 2 years later. But having the approach consisting of saying we have a principle, it's agreed, and the fact that we would touch it would just open the way to whatever, doesn't convince me at all, because the whatever is happening. I will just quote, and that's my final remark, Michael Gratz at the US CIB conference in June, saying, addressing the crowd of US business, don't think of status quo as agreed international tax rules, but think of status quo as growing unilateral measures all over in the world. And I think this is what we're facing, and the real risk is here, I would think.
I mean, two quick comments. I agree with Jim about the need to constrain whatever the new rules are in an effective way. Although I think in the bar case, the people running the bar make the profits. They sell the drink for more than you would pay for it in the supermarket to drink at home. We tax those profits. So there hasn't been the same concern about that. On incentives, I think there are circumstances where countries can't do this, and I don't think that means that they should never proceed. But I think if you can build a system that creates incentives for countries to stay in the game and cooperate, then there is advantage in doing that, because what you've got, I think, is more likely to stick. So I don't think we will necessarily always be able to do that, but I think it does make sense for us to think about that. Have you got rules that reinforce? Have you got rules that encourage countries to apply those rules in a consistent way, or have you got rules that actually disincentivize that? And I think one will be likely to be more stable, or at least easier to administer than the other. So I think we should certainly consider that.
Janine?
Yep. So just a couple of comments. There was a bit of a discussion about individual interest and capitalism and those being motivations. I would just make the point that business today operates in societies. Without society, a business can't make money. They have a number of stakeholders, shareholders being a very important stakeholder, but also their employees, their customers, their suppliers. And the way that businesses today think about their responsibilities is in that broader context, not just through the very narrow prism of responsibility to shareholders. And then the other comment I would just make is that the thing that's going to stop countries going after more, in other words, the whole system breaking down once more, must be that you have a system where dispute resolution is guaranteed. Because without that, there is no check or balance to countries being able to go down that path. So it seems to me that that's a necessary tenet for success.
So please join me in thanking the panelists.